Doing well with money is not necessarily about what you know. It's also about how you behave. However, behavior is hard to teach, even to really smart people. In The Psychology of Money, award-winning author Morgan Housel shares stories exploring the strange ways people think about money and teaches us how to have a better relationship with money and how we can make smarter financial decisions in our financial life. That's why in this video, we'll be going through 7 important lessons from the book, The Psychology of Money by Morgan Housel. 1. Wealth is more than money. Wealth isn't solely about the size of your bank account or the number of assets you own. Instead, it's about life satisfaction and the ability to lead a fulfilling life. Housel introduces the idea of having enough. Once your basic needs are met, the incremental increase in wealth doesn't necessarily correlate with an increase in happiness. In fact, constantly striving for more can lead to stress and dissatisfaction. Some people might get a raise, buy a bigger house, and then realize they are still not as satisfied as they thought they would be. This is known as the hedonic treadmill, which is the tendency for people to adapt to new levels of income and material wealth quickly, continuously upgrading lifestyles, only to find that it didn't bring the lasting happiness they expected. Housel encourages us to define what enough means for us personally. This involves understanding our values, priorities, and what truly makes us happy, rather than blindly pursuing societal or peer-driven standards of wealth. For example, consciously choosing to scale back your lifestyle and expenses, focusing on experiences and relationships that bring you greater joy, or prioritizing work-life balance, choosing jobs or careers that allow you to have more time with your families and pursue your passions. In essence, the pursuit of wealth shouldn't come at the cost of our well-being, relationships, and happiness. It's important to understand that wealth, after all, is more than just money. 2. Embrace the role of luck. While Warren Buffett is celebrated for his investment prowess, Housel points out that Mr. Buffett was born in the right place, the United States, and at the right time, post-World War II economic boom. This fortuitous timing greatly contributed to his success. The truth is that luck plays a substantial role in our lives and financial success. It's important to recognize that many events are beyond our control and difficult to predict. With that said, we should build financial plans and investments with the understanding that unforeseen events can occur. For example, having a financial safety net, such as health insurance and emergency funds, in place to protect against unexpected events such as loss of job and healthcare needs. Or having a diversified portfolio to protect against devastating economic downturns similar to the Great Recession in 2008. In essence, it's important to recognize and appreciate the role that luck plays in our lives. While it's important to plan for the future, it is equally important to also prepare for the unexpected. This perspective can lead to more realistic expectations, better risk management, and a greater sense of gratitude for the good fortune we encounter along our financial journeys. It also encourages us to extend empathy and support to others who may not have had the same luck. 3. The power of compounding. There are 2 investors, Jane and John. Jane starts investing $5,000 per year at age 25 and stops at age 35. John starts investing the same amount at age 35 and continues until he's 65. At their retirement age, even though Jane only invested for 10 years while John invested for 30, Jane's investments will be approximately 3 times more than John. In other words, time is your greatest asset. Housel stresses the importance of starting to invest as early as possible. The longer your money remains invested, the more it can compound. Consistency is also vital. Regularly contributing to your investments, even with small amounts, can lead to significant wealth accumulation over time. The key is to start early and stay consistent. For those less experienced with investing, Housel suggests seeking the guidance of financial professionals who can help tailor investment strategies to individual goals and risk tolerances. 4. Time in the market matters. Successful investors often have a long-term perspective. They understand that financial markets can be unpredictable in the short term, but historically, they tend to trend upward over extended periods. Based on historical data on the growth of financial markets over time, it shows that despite periods of recession, financial crises, and bear markets, the long-term trend of stock markets has been positive. However, it is still a common belief that successful investors possess the ability to time the market accurately. Market timing is exceedingly difficult, as you not only have to predict when to get out but also when to get back in. Some of the best performing days in the market occur suddenly and unexpectedly, often during periods of high volatility. Missing just a few of these days can have a substantial impact on your investment returns because these days often represent the most significant gains. Therefore, staying invested for the long haul can be more beneficial than trying to make short-term predictions. 5. Risk tolerance is personal. An investor who is financially secure, has a long time horizon, and is comfortable with market volatility will have a different risk tolerance compared to one who is nearing retirement, has a lower risk tolerance, and prioritizes capital preservation. In other words, there is no one-size-fits-all approach to risk tolerance. What one person considers an acceptable level of risk may be too high or too low for someone else. Personalized risk tolerance takes into account factors such as an individual's financial situation, goals, time horizon, and emotional comfort with fluctuations in investment returns. Housel encourages us to thoroughly assess our own financial situation, goals, and emotional comfort with risk. Then align our investment strategy based on our risk tolerance. If you are risk-averse, your portfolio may lean more toward conservative investments. If you have a higher risk tolerance, you may be more comfortable with a diversified portfolio that includes equities. In essence, there is no universal risk tolerance that applies to everyone. It's a highly individualized aspect of investing that depends on a person's unique financial circumstances, objectives, and emotional comfort with risk. 6. Nothing's free. Every financial decision, even seemingly beneficial ones, comes with costs and trade-offs. These costs may be explicit, such as fees or taxes, or implicit, such as missed opportunities or time invested. An investment fee as low as 1% can significantly reduce the overall returns on an investment portfolio over the long term. Hence, it is crucial to be fee-conscious when selecting investment products. Minimizing investment fees can have a substantial positive impact on long-term returns. What about the emotional cost? Investors often pay an emotional cost when they react to market ups and downs too. The fear that causes panic selling during market downturns can lead to missed opportunities and financial regrets. By focusing on the long term, investors will be able to weather short-term market volatility and avoid costly emotional reactions. In short, Housel emphasizes the importance of being aware of all the costs associated with financial decisions, not just the obvious ones. At the end of the day, all financial decisions come with associated costs and trade-offs. Nothing is free. 7. Pessimism bias. Optimism sounds like a sales pitch. Pessimism sounds like someone trying to help you. Morgan Housel. Pessimism bias is the tendency for individuals to be overly pessimistic or cautious when assessing future events and outcomes. This bias can be especially prevalent in financial contexts. Negative news and pessimistic narratives tend to capture people's attention. This contributes to heightened pessimism, which then influences investors' financial decisions, such as selling investments in a panic during market downturns or avoiding investing altogether due to fear of loss. It is important for investors to approach financial news and media with a critical eye. Understanding that negative news is often sensationalized can help individuals make more rational investment decisions. Not only that, adopt contrarian thinking. Contrarian investors look for opportunities when others are pessimistic, potentially leading to favorable outcomes such as buying assets at lower prices, being less likely to succumb to market bubbles, and avoiding overvalued assets when everyone else is optimistic. So, there you have it. The Psychology of Money by Morgan Housel is a treasure trove of financial wisdom. These are the 7 important lessons that can transform your financial life. Thank you for watching. If you find this video helpful, don't forget to hit that like button and subscribe for more content like this in the future. Until next time, hope to see you on my next video.